This is a complete finance lease life cycle from the lessee side: asset, liability, interest, and amortization. I'm going to follow the numbers through the model, the journal entries into the financial statements, and show how everything flows over the life of the lease. At the top of the model are the assumptions. The lease term is 3 years. The annual lease payment is $50,000. Payments are made at the beginning of each year. The discount rate is 5%. These inputs drive every calculation below. Here is the present value calculation. There are three payments of $50,000 paid at the beginning of each year because the payments are made in advance. This is an annuity due. Discounting those payments at 5% gives us a present value of $85,782. These numbers becomes the starting point for both the asset and the liability. On January 1st, 2023, the lease is recognized. The right of use asset is $85,782. The lease liability is $85,782. There is no expense and no cash at this point. This is a balance sheet only recognition. Now look at the first payment. On day one, $30,000 is paid in cash because the payment is made at the beginning of the year. No interest has accrued yet. The full payment reduces the lease liability to $55,782, and that's the new lease liability balance. At the end of year one, interest accrues on the remaining liability. The outstanding balance before interest is $55,782. Interest is calculated as $55,782 per 5%, which equals $2,789. The interest increases the liability. $55,782 plus $2,789 equals $58,571. The life of use asset is amortized. The original asset is $85,782. The lease term is 3 years. Annual amortization is calculated as $85,782 divided 3. So amortization for the year is $28,594. After year one, the asset balance is $85,782 minus $28,594 equals $57,188. Year 2 starts with a lease liability of $58,571. The second payment of $30,000 is made. $58,571 minus $30,000 equals $28,571. This is new balance, but interest then accrues at the end of the year. We calculate $28,571 per 5% equals $1,429. And now we have lease liability, which equals $50,000. Amortization remains at $28,594. As a result, the asset balance decreases from $57,188 to $28,594. At the start of the year 3, the lease liability is $30,000. The final payment of $30,000 is made. $30,000 minus $30,000 equals 0. With no remaining liability, no further interest accrues. The final amortization of $28,594 brings the asset to 0. At the end of the lease, both balances are fully reduced. At commencement, rate of use asset $85,782, lease liability $85,782 too. For each payment, lease liability reduced by $30,000, cash reduced by $30,000 too. Each year, interest expense for $2,789, then $1,429, with the same amounts added to the lease liability. Amortization expense of $28,594 each year, reducing the right of use asset. On the balance sheet at commencement, right of use asset increases by $85,782. Lease liability increases by $85,782. Each year after that, the asset increases evenly by $28,594, and the liability decreases overall with temporary increases from interest. On the income statement, this is a finance lease. So two expenses appear. In year one, $28,594 plus $2,789 equals $31,383. In year two, $28,594 plus $1,429 equals $30,023. In year three, $28,594. Total expense declines over time as interest declines. On the cash flow statements, cash paid each year is $30,000. Only the classification changes between principal and interest. Every number in this file comes from three mechanics: discounting the payment, applying interest to the liability, and amortizing the asset straight line. If this model makes sense, finance leases make sense.